What if everything you thought you understood about the silver market was about to change? Not in some distant future, not in a decade, but potentially within the next several months. Welcome back. If you're here, you already know that silver isn't just another commodity. It occupies a unique intersection in the financial world, part precious metal, part industrial workhorse, and increasingly a focal point for investors seeking refuge from monetary uncertainty. But today, we need to have a different kind of conversation. Veteran precious metals analyst John A.G., who has studied silver market cycles for over 3 decades, recently issued what he calls his most serious warning in years. His assessment? The silver market is approaching what he describes as a dangerous turning point, a critical inflection point that could reshape the landscape for both current holders and those watching from the sidelines. Now, before we go any further, let me be absolutely clear about something. This is not about panic. This is not about fear-based decision-making. And this is certainly not about predicting with false certainty where prices will go. What this is about is preparation. It's about understanding the forces converging on this market. And it's about ensuring that whatever happens next, you're positioned to respond with clarity rather than chaos. So whether you currently hold silver in your portfolio or you've been considering an entry point, the next 25 minutes could prove valuable. We're going to break down what John A.G. sees in the data, examine the historical precedents, understand the psychological traps that destroy portfolios during turning points, and most importantly, develop a framework for rational action, regardless of which direction this market ultimately moves. Let's begin. To appreciate why experienced analysts like John A.G. are sounding alarms, we first need to understand exactly where we stand. The silver market has always been volatile. That's not new. What's different now is the unusual convergence of factors creating what technicians call a compressed spring scenario, a situation where multiple forces are building tension simultaneously, often preceding significant movement in one direction or the other. Let's examine these forces individually. Silver isn't just a store of value. Approximately 50% of global silver demand comes from industrial applications. This makes silver fundamentally different from gold, which derives less than 10% of its demand from industry. Solar panel production alone now consumes a substantial and growing portion of annual silver supply. Electric vehicle manufacturing requires silver. The entire green energy transition is, in many ways, a silver-intensive transformation. Medical devices, electronics, water purification systems, the list continues to expand. John A.G. points to this industrial demand growth as one side of the equation, but he cautions against viewing it in isolation. Industrial demand is ultimately tied to economic activity, and economic activity, as we'll discuss shortly, faces its own set of uncertainties. Here's something that doesn't get discussed often enough. Silver mining is frequently a byproduct operation. A significant percentage of silver production comes from mines primarily extracting lead, zinc, copper, or gold. Silver is what comes up along with the main target. What this means is that silver supply doesn't respond to price signals the way traditional economic models might suggest. Higher silver prices don't necessarily incentivize dramatically increased silver production because most producers aren't primarily silver miners. Their decisions are driven by the economics of their primary metals. This supply inelasticity creates interesting dynamics during periods of increased demand. It also means that any genuine supply deficit can persist longer than markets initially anticipate. John A.G. has tracked primary silver mine output for years, and his data suggests that primary production has struggled to keep pace with the demand trajectory. But, and this is important, supply constraints alone don't guarantee price appreciation. They create conditions. They don't determine outcomes. We cannot discuss precious metals without addressing the broader monetary landscape. Central banks globally have navigated extraordinary territory over the past several years. Interest rate policies, balance sheet adjustments, and inflation management have created a complex environment for all asset classes. Silver, traditionally viewed as both an inflation hedge and a monetary metal, sits squarely in the middle of these policy debates. When real interest rates, that's nominal rates minus inflation, turn negative, holding non-yielding assets like silver becomes relatively more attractive. When real rates rise, the opportunity cost of holding silver increases. John A.G.'s warning incorporates his assessment of where monetary policy may be heading. His concern isn't about predicting specific central bank decisions. Rather, it's about recognizing that we may be entering a period of heightened policy uncertainty, where market reactions become more volatile and less predictable. Beyond industrial consumption and monetary factors lies the wild card: investment demand. Silver investment vehicles, from physical bullion to exchange-traded products to mining equities, introduce a layer of demand that can shift rapidly based on sentiment. Unlike industrial users who require silver for production, regardless of short-term price movements, investment demand can surge or collapse based on narrative, fear, optimism, or simple momentum. This is where John A.G.'s dangerous turning point thesis centers. He observes that investment positioning in silver has reached levels that historically precede significant market moves. Not always up, not always down, but significant moves nonetheless. The danger, in his assessment, isn't about direction. It's about the magnitude of potential change and the speed with which it could occur. Markets have memory, not in some mystical sense, but in the very real patterns that emerge when similar conditions repeat. Let's examine what history teaches us about silver market turning points. Most students of the silver market know this story. The Hunt brothers' attempted corner of the silver market drove prices to unprecedented levels before a spectacular collapse. But the lessons extend beyond the obvious narrative of market manipulation and regulatory response. What that period demonstrated was how quickly sentiment can shift in concentrated markets. Silver moved from extreme bullishness to panic selling in a remarkably compressed time frame. Investors who had accumulated positions during the rise found themselves unable to exit at anything close to their expected prices. The lesson isn't that history will repeat exactly. It won't. Conditions are different now. But the lesson about market psychology, about how quickly crowd behavior can reverse, remains entirely relevant. More recently, silver reached significant highs in 2011 before entering an extended decline that lasted years. Many investors who entered during the final stages of that rally experienced painful losses, not just from the initial decline, but from the prolonged period of underperformance that followed. What made 2011 instructive was the disconnect between narrative and reality. The bullish case for silver remained compelling even as prices fell. Industrial demand was growing. Monetary policy remained accommodative. Supply constraints were real, yet prices declined anyway for years. John Agee frequently references this period in his analysis. His point isn't to suggest the current situation mirrors 2011. His point is to remind us that compelling fundamental cases don't guarantee immediate price appreciation. Markets can diverge from fundamentals for extended periods, and investors who fail to account for this possibility often make poor decisions. Every market cycle follows a recognizable emotional pattern: disbelief during early stages, gradual acceptance, enthusiasm, euphoria, anxiety at the first signs of trouble, denial, fear, capitulation, despair. And then, eventually, disbelief again as a new cycle begins. Where are we now in the silver market cycle? This is the critical question, and honest analysts will admit they can't answer it with certainty. John Agee's assessment suggests we're at a point where multiple cycle interpretations are possible. Are we in late-stage enthusiasm approaching euphoria? Are we in a consolidation phase within a longer bull market? Or are we at the beginning of something larger that hasn't yet attracted mainstream attention? The fact that reasonable analysts can defend different positions should itself tell us something important. Turning points are, by definition, moments of uncertainty. If everyone agreed on the direction, the turn would have already occurred. Let's get specific about what John Agee sees in the current data that prompts his warning. Commitment of Traders data, which tracks how different market participants are positioned in futures markets, has shown unusual patterns. Without getting into the technical weeds, the key observation is that speculative positioning has reached levels that historically coincide with significant price movements. John Agee emphasizes that positioning data doesn't predict direction. What it indicates is potential. When many market participants are positioned heavily in one direction, the market becomes vulnerable to rapid reversals if sentiment shifts. It's like a crowded theater. Everything seems fine until someone yells fire. Another pattern John Agee highlights involves the relationship between physical silver markets and paper silver markets. At various points, premiums for physical silver, the amount above spot price that buyers pay for actual metal, have shown unusual behavior. These divergences sometimes signal stress in delivery mechanisms or shifts in underlying demand patterns. He's careful not to make too much of any single data point, but the pattern of divergences, viewed collectively, suggests a market under unusual stress. Large institutional players leave footprints in market data. Their accumulation or distribution patterns, while not always immediately visible, eventually become apparent through careful analysis. John Agee's research suggests that some institutional behavior patterns have shifted in ways that warrant attention. Again, not predictive in themselves, but worth noting when combined with other signals. Perhaps most concerning to John Agee is what he describes as selective complacency among retail silver investors. He observes a population of holders who have developed strong conviction in their positions, often based on compelling long-term fundamental arguments. This conviction can be an asset during normal volatility. It prevents panic selling during routine pullbacks, but it can become a liability at genuine turning points if it prevents rational reassessment of changed conditions. The question John Agee poses to silver holders is uncomfortable but necessary. Could your conviction be preventing you from seeing warning signs? Are you evaluating current conditions, or are you defending past decisions? If you currently hold silver in any form, this section is specifically for you. First, let me acknowledge something. Hearing warnings about an asset you own creates psychological discomfort. There's a natural tendency to either dismiss the warning or to panic. Neither response serves you well. The appropriate response is measured assessment, followed by deliberate action or deliberate inaction. Let's work through this systematically. Before considering any changes, understand what silver represents in your total portfolio. If silver constitutes 5% of your investment assets, your situation differs dramatically from someone for whom silver represents 50%. There's no universally correct percentage for any asset class. But there is a universally correct question to ask. If silver declined significantly from current levels and remained depressed for an extended period, would that outcome compromise your financial security or prevent you from meeting important goals? If the answer is yes, that's information worth having. It suggests your position may be larger than your actual risk tolerance supports, regardless of your conviction about silver's long-term prospects. Not all silver exposure is equal from a risk perspective. Physical silver that you hold for long-term wealth preservation purposes occupies a different category than silver mining equities held for capital appreciation. Exchange-traded products introduce counterparty considerations. Leveraged positions introduce margin call risk. Evaluate each component of your silver exposure separately. A well-structured physical position might warrant different treatment than a speculative mining stock position. Why do you hold silver? What is the investment thesis that led you to this position? If your thesis is genuinely long-term, measured in decades rather than months, then short-term turning points, while noteworthy, may not require dramatic action. The danger lies in holding assets based on a long-term thesis while managing them with short-term emotions. Conversely, if you entered silver positions expecting relatively quick gains, a turning point warning carries different implications. It may be worth reassessing whether your original thesis remains intact. One of the most underutilized strategies during periods of uncertainty is the partial position adjustment. Rather than making binary decisions, all in or all out, consider whether adjusting position size by a measured percentage might address your concerns while maintaining exposure to potential upside. If you're uncomfortable with your current silver allocation, reducing by 20 or 30% might bring you to a level where you can observe market developments without anxiety. You don't have to make perfect decisions. You have to make decisions you can live with. The most sophisticated approach to uncertainty isn't predicting what will happen. It's preparing for multiple possibilities. Literally write down how you intend to respond if silver rises significantly from here. Then write down how you intend to respond if it falls significantly. Then write down your plan if it moves sideways for an extended period. This exercise serves two purposes. First, it forces you to think through scenarios before emotions become engaged. Second, it creates a commitment device, a pre-decided course of action that can guide you when emotional decision-making becomes most tempting. For those in taxable accounts, any changes to silver positions may trigger tax events. This doesn't mean taxes should prevent necessary portfolio adjustments, but it does mean the net impact of any change includes potential tax consequences. Sometimes, the optimal financial decision is to take no action because tax costs outweigh adjustment benefits. Other times, taxes are simply the cost of rational portfolio management. Run the numbers before making significant changes. Perhaps you don't currently hold silver but have been considering a position. John Agee's warning contains different implications for you. Let's address this directly. Trying to time market entries perfectly is extraordinarily difficult. Most investors who attempt precise timing end up either entering too early, too late, or never entering at all because they keep waiting for better conditions. A turning point warning might seem like useful timing information. But remember what turning point actually means. It's a moment of maximum uncertainty, not a moment of clarity. Knowing that something significant may happen is different from knowing what that something will be. There's a psychological asymmetry in how investors experience regret. Missing a gain feels different from taking a loss, even when the dollar amounts are identical. This asymmetry causes many potential investors to wait indefinitely on the sidelines, repeatedly telling themselves they'll enter when conditions become clearer. Conditions never become entirely clear. By the time they do, the opportunity has often passed. John Agee's warning isn't necessarily a signal to stay out of the silver market. It's a signal that entry decisions should be made carefully and strategically. If you've decided that silver deserves a place in your portfolio but are concerned about near-term volatility, dollar-cost averaging offers a middle path. Rather than committing your intended allocation all at once, spread purchases over a predetermined period, perhaps 6 months or 12 months. This approach sacrifices potential upside if prices rise immediately, but it provides protection against the risk of buying at a near-term peak. Dollar-cost averaging is neither optimal nor pessimal. It's a strategy that acknowledges uncertainty and manages the emotional difficulty of entry decisions. Before investing anything in silver, ensure you understand what you're investing in and why. What is your thesis? Is it an inflation hedge? Industrial demand growth? Currency debasement protection? Portfolio diversification? There are multiple legitimate reasons to own silver, but different reasons suggest different position sizes, holding periods, and vehicle choices. Someone investing in silver as a small portfolio diversifier might appropriately choose a silver ETF for convenience. Someone investing in silver as long-term wealth preservation might prefer physical metal, despite storage considerations. Someone seeking leveraged exposure to silver price movements might consider mining equities with their additional company-specific risks. Match your investment vehicle to your actual thesis. There's psychological value in establishing even a small initial position in an asset you're considering. A starter position, perhaps 1/4 or 1/3 of your intended ultimate allocation, transforms you from observer to participant. You begin paying attention differently. You experience how price movements affect your psychology. You develop opinions based on actual ownership rather than theoretical consideration. If conditions warrant, you can add to the position over time. If your assessment changes, you've limited your exposure. A starter position is a learning position. Now we arrive at perhaps the most valuable section of our discussion. These are the behavioral errors that destroy portfolios during market turning points. Regardless of which direction silver moves from here, avoiding these mistakes will serve you well. Markets generate emotions. Prices rising generate excitement and fear of missing out. Prices falling generate anxiety and panic. Sideways action generates boredom and impatience. None of these emotions are useful guides to action. The decisions you make about your silver holdings should come from the rational part of your mind, not the emotional part. If you find yourself wanting to buy because you're excited or wanting to sell because you're scared, that's precisely when you should stop and do nothing until the emotion passes. This is easy to understand intellectually. It is extraordinarily difficult to practice consistently, but mastering this single skill, the ability to not act on emotion, is worth more than any amount of market analysis. Leverage magnifies both gains and losses. It also introduces forced decision-making through margin calls, situations where you must sell, not because you want to, but because you have to. During turning points, when volatility increases, leverage can transform manageable situations into catastrophic ones. Positions that would have recovered given time instead become permanent losses because leverage forced to exit at the worst possible moment. If you currently hold leveraged silver positions, seriously consider whether that leverage is appropriate for a period of potential market stress. The additional upside potential may not be worth the risk of being forced out of your position at precisely the wrong time. During periods of market stress, the temptation to consume more information intensifies. You want to understand what's happening. You want to feel prepared. But past a certain point, additional information doesn't improve decisions. It creates confusion. Every additional analyst, every additional opinion, every additional data point can muddy rather than clarify. Identify a small number of trusted information sources and ignore the rest. You don't need to know everything happening in the silver market. You need to know what's relevant to your specific situation and decisions. Before any turning point arrives, you should have a strategy. Maybe it's a long-term hold strategy. Maybe it's a tactical trading strategy. Maybe it's a systematic rebalancing strategy. Whatever your strategy, turning points will test your commitment to it. There will be moments when your strategy appears to be failing. There will be pressure to abandon it for something different. Sometimes strategy changes are appropriate. Circumstances change, information changes. But most strategy abandonment isn't rational response to changed conditions. It's emotional capitulation to short-term pressure. Before you change your strategy, ask yourself honestly, am I changing because conditions have genuinely changed? Or am I changing because following my strategy has become emotionally uncomfortable? We discussed position sizing earlier in the context of current holders, but it deserves emphasis here among critical mistakes. Position sizing is not a secondary consideration. It's not something you figure out after deciding what to buy. Position sizing is the primary risk management tool available to individual investors. A brilliant investment thesis in an oversized position can still devastate your finances. A mediocre investment thesis in an appropriately sized position limits damage regardless of outcome. Think of position sizing as your insurance policy against being wrong. And remember, at turning points, the probability of being wrong is elevated. If your silver holdings have appreciated, that appreciation exists only as numbers until you actually sell. Paper gains are not real wealth. They are potential wealth that can appear and disappear with price movements. This doesn't mean you should immediately convert all gains into cash, but it does mean you should be honest about your actual financial position versus your portfolio's current valuation. During turning points, portfolio values can change dramatically. Investors who have mentally spent their paper gains often make poor decisions when those gains evaporate. What are other silver investors doing? What do the forums say? What's the consensus view? These questions are natural to ask, but dangerous to answer too heavily. Crowds are often wrong, especially at turning points. The consensus view is typically most confident precisely when it's about to be proven incorrect. If you're making decisions based on what others are doing rather than your own analysis and circumstances, you're vulnerable to crowd psychology errors. You're not investing for other people. Their situations differ from yours. Their risk tolerances differ. Their goals differ. Make your decisions based on your analysis and your circumstances. Whatever has happened recently feels like it will continue. If silver has been rising, it feels like it will keep rising. If it's been falling, it feels like it will keep falling. This is recency bias, and it leads investors astray constantly. Markets trend, yes, but they also reverse. The skill lies in distinguishing between trends that will continue and trends that are about to end. Recency bias tricks you into assuming continuation every time. At turning points specifically, recency bias becomes most dangerous because the recent trend is, by definition, about to change direction. Let's step back from the specifics of silver market analysis and consider some broader truths that apply regardless of how this particular situation resolves. Whether you own silver or not, whether silver goes up or down, your overall financial success depends on a collection of decisions made over decades. Getting silver right while getting everything else wrong leads to failure. Getting silver wrong while getting everything else right leads to success. This perspective helps prevent the outsized emotional attachment that leads to poor decision making. Silver matters. It doesn't matter infinitely. There will never be a time when the future is clear. There will never be a moment when making investment decisions becomes easy. The uncertainty you're experiencing now about silver is the same uncertainty you'll experience about every investment decision for the rest of your life. The goal isn't eliminating uncertainty. It's developing the skills and frameworks to make reasonable decisions despite uncertainty. Those skills transfer across asset classes and across market conditions. If you have decades ahead of you, short-term market movements matter far less than most people believe. A 5-year bear market in silver, while unpleasant, doesn't prevent eventual recovery given sufficient time. This doesn't mean you should ignore market conditions entirely, but it does mean you should calibrate your concern to your actual time horizon. Investors with decades ahead of them should worry less about near-term turning points than investors who need their capital soon. You cannot control outcomes. You can only control process. A good decision can lead to a bad outcome. A bad decision can lead to a good outcome. Over single instances, there's no reliable connection between decision quality and result quality. But over many decisions, over years and decades, good processes reliably outperform bad processes. Your focus should be on making good decisions, well-reasoned, appropriately sized, emotionally controlled decisions, rather than on achieving good outcomes. If you make good decisions and experience bad outcomes, that's variance. Keep making good decisions. If you make bad decisions and experience good outcomes, that's luck. It won't persist. We've covered substantial ground together. We've examined the factors that have brought the silver market to what John Agee identifies as a dangerous turning point. We've reviewed historical precedents and the lessons they offer. We've developed frameworks for both current holders and potential investors. We've cataloged the critical mistakes that destroy portfolios during periods of market stress. Now, as we close, let me leave you with some final thoughts. John Agee's warning is serious and worth considering, but it's not a prediction. No honest analyst predicts with certainty. It's an assessment of conditions, an observation of patterns, and a call for heightened attention. The word dangerous in his assessment refers not primarily to price direction. It refers to the risk of making poor decisions during a period when decision quality matters most. The danger lies in panicking. The danger lies in becoming reckless. The danger lies in abandoning discipline at precisely the moment discipline matters most. Whatever happens in the silver market over the coming months and years, your response to it will matter more than the events themselves. Investors who maintain emotional control will navigate successfully. Investors who surrender to fear or greed will suffer, regardless of market direction. If there's one message to carry forward from this discussion, it's this. Prepare now, while you can think clearly before events unfold. Decide in advance how you'll respond to different scenarios. Make those decisions when your rational mind is engaged, not when your emotional mind is activated. Write down your plan. Share it with someone you trust. Create accountability structures that will help you stick to your process when sticking becomes difficult. The silver market may indeed be approaching a significant turning point. John Agee's analysis suggests elevated risk of meaningful change. But turning points, while dangerous, are also opportunities. They're opportunities to demonstrate the discipline you've developed. They're opportunities to apply the frameworks you've built. They're opportunities to make good decisions while others make poor ones. You've invested time in developing your understanding. Now invest time in developing your response plan. Whatever unfolds, you'll be better prepared than those who haven't done this work. I'll continue bringing you analysis and perspective as the situation develops. In the meantime, stay focused, stay disciplined. And remember that your long-term financial success depends not on any single market call, but on the consistent application of sound principles over time. Thank you for your attention. Until next time.